you can fight inflation. What ultimately has to happen is you've got to bring demand in line with supply. And you either do that by raising supply, which is what they were hoping would happen, and that supply chain, all these kinks that we saw in the supply chains would work their way out and not have to do too much to dampen down demand. Well, now they're hitting the brakes pretty hard.
Yeah.
And they're looking at, raising rates the most aggressively, the fastest we've seen really in decades. And they've lifted off already in March. They expect their next move to be 0.5%, and they could get as many as 8 hikes in this year, with the remainder of the year left. That is faster than anything we've seen in the last several decades, 2 decades, anyways. And I think that's important. How do manufacturers think about this environment with a higher interest rate environment as well? Because that really is going to be important if they've got debt.
To be honest, Diane, I don't know if I have a good solid answer to that, because if you're a manufacturer and your balance sheet is strong and you're not heavily debt laden, you're going to do okay, right? But if you extended yourself and you're exposed to that interest rate high, it's not going to be a pretty thing for you. On the good side of that, balance sheets are generally strong, and they're generally strong for manufacturers. So hopefully that impact, or the impact of those rising rates, will lead to more of a softer, to use your parlance as an economist, a softer landing versus a crash, right? Hopefully that will happen, but I think time will tell. So I
Yeah,
think those
that's
that
what.
have paid attention to their balance sheet and their economic health are going to weather it like they always do, and those that are overextended are going to feel some pain.
Well, and it goes beyond the interest rate issue, and that this is one of the issues that I mean, I have a hard time squaring the Federal Reserve's own numbers. In their most recent uh, rate hike move, they redid their forecast. They marked down growth dramatically. They raised interest rates dramatically. They raised their inflation forecast dramatically. That we're going to have higher inflation for longer than they had thought, and they have to respond to that. What they didn't do at all and didn't change in all that, which sort of doesn't add up, is they didn't change their numbers for unemployment rate. They still have the unemployment rate falling, which is a bit fanciful to think that we'll be able to do this without really hitting demand a little harder, which will pinch some of those
Yeah.
manufacturers that are trying to pass along costs, of their higher costs, the inflation environment that they've been able to pass along costs in, the like you mentioned before, maybe a window that's rapidly closing, which
And I
means they
think it
should be
is.
looking on those other aspects of their, how can they increase efficiencies elsewhere.